Alrighty, it is 11 o'clock, and I think that we can get started. So I know that we're already asking for 2 hours of your time. So we want to make sure that we try to, respect your time as much as possible. So hopefully more people join as we go along. So good morning, everyone. Thank you for joining the session and welcome to the Financial Modeling Sprint by Leonine Learning. So my name is Sekinat Alao. If you can hear me loud and clear, please just put in the chat section yes, and we'll be good to go. So if you can hear me loud and clear, just say yes, and I'll just continue my introduction. So my name is Sekinat Alao, and I lead operations at Leonine, and I'll be your uncle or MC if you for this session today. So you don't want me to take you through the modeling, trust me, you don't want me to do that, but I'll be the one to kind of guide the session on and give a run through of the agenda today. So if you're just coming across the brand, if you're just coming across Leonine, so maybe you saw our ads or it was like somebody invited you to this session, let me give a brief rundown about what we do at Leonine. Okay, fantastic, you guys can hear me. All right, so Leonine for short is for Leonine Investment Services. So we have two arms, right? So we have Leonine Investment Services, which is a financial advisory and consulting firm, right? We work with like small, medium, large corporates, NGOs, government agencies. We provide services such as building models for them, valuation, independent valuation. We do business planning, and we do so many other things as long as like financial transaction support, capital raise for these businesses. Then Leonine Learning, which is hosting this session that you're in, basically helps to equip professionals across various industries, but particularly professionals in the finance industry on skills that will boost their productivity, make them more valuable employees to whatever companies they are situated at. And if you want to run a business, we kind of equip you with those skills that will make you more productive, right? So some of our training services include Microsoft Excel trainings, data analysis using Excel, Power BI, business intelligence and reporting, building financial modeling. So throughout our inception since 2018, we've reached over 1,000 professionals and counting, and we're hoping that we are able to serve you, and you're going to be part of those group of people that we also serve, right? So we do both free and paid trainings. So you're in one of the free trainings, right? And I know a couple of you, some of you have joined, some of our previous trainings in the past, but for everyone that is new, welcome, and we hope that you have an amazing experience. So now that I've introduced myself, I want you to just tell us who you are, your name, where you're joining from this morning, and tell me how you're feeling this Saturday morning. I am feeling pumped, I'm feeling excited because I'm all about serving, so I'm here to serve you, and I can assure you that my colleagues on this team are also feeling the same. So just let me know your name, where you're joining in from, and how you're feeling this morning. Right, so I have my colleagues on this call to support you. I have Ridwan, I have Ola. You might have heard from Ola. He has been sending you messages. So we are all here to support you. And I'll go ahead to introduce what we're in this session. So what's the objective of the session? So we felt like a lot of you might have learned about financial modeling, you've heard about it, you've watched videos, but some of you might not have done like sessions, and we feel like, oh, it's not just talking, we also want you guys to do, right? And so we brought up this session particularly because we see that a lot of the ASU strike has been on for a while, which we really, really empathize. I'm sure everyone on this call also experienced it when we were in school, right? So we felt, okay, instead of just saying stuff, we want you guys to build. So it's basically like a DIY session where you are to build a model with us. So it's a simple model, and we hope that everyone, as much as many people will be able to follow through with this session, basically. So I'm going to introduce the facilitator for today. Is Habib Olusoya. I'm sure you can see him on the screen. He's a financial analyst with Leonine. He's been with us for almost 3 years now. So he started with us as NYSC intern, and he's grown so much. So yeah, so he facilitates training, and it also works on our investment side of things, right? So he'll be your facilitator today. But like I said, we have people, other analysts on the call here to answer any questions. So I'm going to go through a couple of ground rules. So everyone is muted automatically, but during the session you're allowed to ask questions because we want to carry you along, right? So you can ask questions in the chat section, but if you do think that it's really urgent, you could just raise your hand up. So there's a raise hand button. You see reactions. So there's a raise hand button and unmute, and you can ask questions. So Habib will go through. So after maybe the section, he'll leave room for question and answers, right? And yeah, so let's try and keep quiet as much as possible. Try to focus on the lesson so that you get the best experience. We've shared some resources with you before this call, so we expect that you would have downloaded them and be ready to go, right? So it's not just, we don't just want you to look at our faces or be distracted, but we also want you to follow along. Right, so this is like a teaser session. We do have, like I said, we provide financial modeling trainings, both physical, virtual, online trainings, but we do have an online course, which I'll share more details about later. We have a ridiculous offer for you guys, but I'll share that later. So without wasting too much time, Habib, take the floor.
All right, thanks a lot, Sakina, for the foundation. Hello, everyone, and welcome to the financial modeling sprint class. We'll be building a financial model in 2 hours today. So let's jump into it quickly. Okay, so welcome again, everyone. So we'll be looking at building financial models today, and then I'm Habib Olusonya, as Sakina introduced me, and I'm your facilitator today. So let's jump into financial modeling. At the end of this class, everyone will be able to understand what financial modeling is, understand what financial models are used for, and then how do you build financial models. That will also be learned in this class. And then, as we promised, we'll build a simple model also. So let's jump into it. First, what's financial modeling?
Habib,
yes.
Excuse me, please. Just to, I think some people couldn't download the Sprint file. So Ola, please share the file in the chat section so that people can get download it before you start. But you can start the introductory session. But Ola, please share that in the chat, and please make sure to share or pin it so that people can easily come across it.
All right.
Thank you.
All right. Yes. All right. So let's continue. Yeah. So a lot of people have been hearing the word financial models. So what do financial models actually mean? I know this might be the first time some people are hearing about it, and a lot of people might have read about it severally. But now we'll go into it deeply and try to understand what really it is. So first, what's financial modeling? A financial model is a mathematical representation of a real-life situation or a real-life business. So what financial model is you have a business. Let's say you run a fashion business, you run a food company, and then you are trying to test out different scenarios. And then you don't want to start testing it out in your business to now see what the impact would be. Rather than testing it out in your business and then having a negative impact which might run down your business, a financial model helps you to numerically build or simulate your business in an Excel spreadsheet and then see different possibilities, and then based on those possibilities you've seen, make the right decisions for your business and then ultimately help it grow, right? So some of the objectives that's one of the objectives of why people build financial models. Another objective is to support decision making. So you don't just want to make decisions without knowing the facts of your business, right? So a financial model helps you to think through different aspects or parts of your business and then test out different things and then make the right decisions to ultimately help your business. And then you might also have capital where you don't know the right way to allocate it to help grow your business. A model helps you in achieving that. And then you might also want to value your business. So let's say you're trying to sell, a financial model helps you in that aspect also. And then when you're trying to see the performance of your business, or if you're trying to get capital, they might want to see how your business has been performing. A financial model helps you measure the historical performance and then see it with how measure the historical performance of your business and then see the trend if it's performing well enough or not. And then based on that, you can then now play with the parameters and see what you need to do to make your business reach where you want it to be. And then if you're also working, also see where the company you're working in as a financial analyst or a manager or whatever you are in the company, help move the business to the next level. So now let's move on to attributes of a typical financial model. So when you say typical financial model, for it to be a good financial model that you're building or you're working with, what do you need to do to make it a strong financial model? So the first thing is your financial model has to be accurate. If your model is not accurate, then it's rubbish, right? And for your model to be accurate, as we mentioned shortly, your inputs needs to be accurate and correct. Your model also has to be clear, meaning someone has to be able to pick up your model and then understand what you've done. If you don't build your model in a clear manner, then the model is not so useful. And then your model needs to be structured, which also ties to the clear point I mentioned earlier. It needs to move from point A to point B to point C, such that someone can read through it like a book and understand it through the structure. And then finally, your model has to be flexible. Let's say you want to change one parameter and see what the impact will be. Your model should be able to do that. So moving on to the next thing, I already explained the model. So you have a real business, or you're working for a company, or you own the company, or you own your own small business, whichever. So you're trying to now test out different things and see the impact of those things on how it will help your business. So you have a real world problem. You then build a model for that business and then test out different things. And then based on your test, you now use the model to decide on things that can make your business better. So next is uses of financial model. I know there might be some questions already, but at the end of this presentation, there will be a 5-minute window where you can ask your questions. So uses of financial models. So I already mentioned some earlier, but just to dig in a bit more. A financial model is used for profitability planning, right? So you want to see your business operations, how the numbers is moving, and then you want to also track your profitability margins and see if it's actually going up or down. Then from your model, you can easily see, oh, the cost of sales is going up, and although our revenue is going up, but our cost of sales is going up more. So we need to improve on our cost of sales, and that might mean we trying to improve our supply chain, or we need to try to be more efficient, or whatever things you need to do. That helps you point out the problem and then plan better. Same with liquidity planning. So from a financial model, you can easily see your amount. You can calculate ratios such as your equity to debt ratio and other ones, right? And then based on that, you can easily see, oh, if you have a lot of debt, how long will it take you to pay off your debt? Do you need to raise more money so that your business can move? As everyone knows, cash is the blood of business. So you need to also plan to ensure that there's always money in your business. If not, the business just dies. So a model is useful for that. And as we've mentioned already, a model is useful for decision making. And then when you're trying to, so for example, if your business is big or you work in a company where you're trying to acquire new companies, you might need to build models for those companies so that you can understand and know the value of the business. And then once you know the value of the business, you can then now advise your management on the right price to buy that business and other things that might happen during the M&A process. So moving on, a financial model is also useful for budgeting. You might need to plan for, okay, you've seen the historical performance this year and you want to see the next financial performance for the next year. A financial model helps you in planning and budgeting also. And then finally, It helps before final one. It helps in capital raising. When you're trying to raise capital, the investor wants to see how your business has been performing over the years. So a financial model helps you to show your business performance over the years and also show the impact of the capital on your business once you've gotten the money. And then finally, for research, for equity research, financial models are also useful. So now let's move on to we're moving into the main part now. So what's the process of building a financial model? First, if building a financial model, there are three main parts or three main structures in building a financial model. And let's just lay that down quickly. So you need the input. The input is important, and then after the input is where the assumptions for your business is put in. So as mentioned in the slide here, so revenue assumptions is the money you're bringing in, and then for the revenue you need to know the drivers for your revenue. Let's say a company that sells gala. A company selling gala, for it to know its revenue, there are two things that you must know, and those two things must be in your model. The first is for your input. So let's do this. The first is you need to know, let's say a company selling gala, it needs to know the volume. So we're doing revenue now. The company needs to know the volume of gala it will sell in a year, in a month, whichever. You need to know the volume of gala to be sold, and you need to know the price. So once you know the volume and the price, that helps you know the revenue you make, and that's basically what the revenue assumption is. So you now need to know what's going to be the volume throughout the forecast year. How much do you plan to sell? How much price? How much are you going to sell it over the years also? And that's what the revenue assumption is. Operating assumptions also, what's the cost of the raw materials, the cost of the labor that's going to work on that, and then the variable costs, also the direct variable costs. The indirect one fall into other options, but everything is the operating. So then you also need to have assumptions for financing. Are you raising capital, or are you raising equity? Are you raising equity capital? Or are you borrowing money? That's the financing. Those assumptions. So if you are borrowing money, how much do you want to borrow every year? Those are the assumptions, and then that now fits into your long-term liabilities or short-term liabilities. And then you also need to have the capex assumption. So do you plan to open another factory? Do you plan to get new cars or new trucks for moving your goods? So those assumptions, you need to know the amount of money you want to use to open a new factory, buy a new machine, and those costs will also tie into your model because they help to determine the depreciation, and then ultimately in your balance sheet that helps you determine the PPE, which is a key aspect. So once you know these assumptions, multiplying the assumptions helps to get your computations, and ultimately those computations help to get your output. I'm going to practicalize all this in this course, so let's get ready for that. So that's the key aspect, the input, the workings, and then the output. But when you're trying to build model, even before you start doing the inputs, workings, and output, you need to understand the business. So let's say you're building a model for someone, or your company is trying to acquire another company. You need to understand what that company does in detail, and then analyze the company and the industry. Then build your model layout, build your historical financial analysis, which is laying out the historical revenue amount, the historical income statement, balance sheet, and then the cash flow statement, building your forecast, and then analyzing your forecast by using ratios and dashboards. So next thing now for us is we're done with this, but if you have any, so over the next 5 minutes, if there are any questions, now is a good time to ask. So you can raise your hand, and then my colleagues will unmute you to ask your questions, or you can also ask from the chat box. In 5 minutes, any questions or comments?
So I've unmuted the mic, so you can unmute yourself if you have a question. Just please make sure that you are muted if you're not asking any questions. So you can unmute yourself if you have any questions so far.
Hello.
Hello.
Yeah, please, can you go to the previous slide?
Okay.
Okay, income statement, cash flow.
This slide.
Yeah. Okay, so
can you introduce yourself first?
My name is Taiwo. Yeah, I'm an economics student. So I'm just following the structure. Okay, so these assumptions are going to be made, and then okay, we'll make the computations, and then we have this. Okay, we have the effects in the P&L, balance sheet, and cash flow. Where is the place for historicals? Are the historicals going to be in the input or where?
So the historicals are going to be on the output sheet, right? And then you can now calculate and you can then do ratio analysis on the input sheet. I'll show that shortly once we get into the real model build.
Okay, are we going to get the slide, please? Are we going to get the slide after the presentation?
My colleague is going to answer that, but you get the slides.
Thank you.
Yeah. Any other questions from anyone?
Yeah, hello, good afternoon.
So you get the recording. You get the recording after the presentation. You get the recording via email. Yeah.
Okay, yes. Next question. Please introduce yourself and ask a question. Hello? Is anyone asking a question again? Any other question?
Habib, there's a question from Mustafa. He says, for new companies, how do we go about the historical financial analysis?
Okay, so for new companies, they don't have any historical numbers. So you don't have historical numbers. So you have to analyze the industry, understand what they're trying to do, and then just build in inputs for them over the forecast period. So those kind of companies are called greenfield companies. So no historical analysis will be needed for them. To just make it clearer, let's say the Gala company doesn't have any historical. What you then need to know is over the forecast period in the first year of operation, how much Gala did they want to sell, and how much do they want to sell it, right? Volume and then price, and then you multiply that to get your revenue. But let's say the company had historical. You could then, from the historical, you could have seen, for example, that they made maybe 500 million in sales of Gala, and then from the 500 million they made in sales of Gala, you can, in your mind, have an assumption that there are different ways to build the model, but one way could be in the next year they want to increase their revenue by 10%. So one way to build that, which we are going to do that kind of method here, is then increase that historical number by 10%. So that's when forecast historical could be useful. But if there's no historical, you can also build your model easily without that. So I'll take one more question, and then if there's any, and if there's none, then we'll move to the model build quickly.
Sorry, good morning. I just started.
Morning.
I'll give a recap, just a summary of what I've been taught through.
Okay. Okay, so let me just do a quick summary again. So we started with explaining what financial modeling is. So financial modeling is a way of modeling a business into an Excel, modeling it, a mathematical representation, a mathematical modeling of a business to help you understand it and then make decisions to ultimately help grow the business. So there are different reasons why you build a financial model to support your business growth, forecast, and planning, to help you allocate resources efficiently to different aspects of your business, to help you in valuing your business, to help you compare historical performance of your business over a period of time, and then look at that with forecast performance to see how your business is going to perform. And then I also talked about the attributes of financial models. So your financial model must be accurate, it must be clear, it must be structured in a very clear and succinct manner, and then it must be flexible. So for modeling, your model has to be, or it is, modeling a business into an Excel or into a mathematical model that helps you in making decisions and planning better for your business. And a financial model can be used for planning your business to be more profitable, for liquidity planning, for helping you make decisions and making the decisions much better, for valuation purpose, which means when you're trying to value your business for a potential, or when you're trying to buy a new business, or just to know what the value of your business is. And then it can also be used for budgeting. Most companies perform annual budgets. So when you're trying to budget, measuring actual numbers, historical, and then seeing the forecast is something a financial model is very valuable for. And then a financial model also helps in capital raising when you're trying to raise capital for expansion of your business. And then for investment research too, financial models are useful. And then in terms of process of building financial models, a financial model has three main segments overall. The first is the input, where you put in the assumptions of how you want your business to perform over the forecast period. And then once you have your assumptions, you need to now compute the assumptions by doing some multiplications, additions, and that's the computation part, also called workings, where you calculate your workings. That's calculating maybe volume times price for revenue, or percentage for cost of goods. So maybe it's the percentage of revenue. So you multiply the revenue and then the percentage that the cost of goods is. And then for other assumptions like raising capital, those assumptions also fit into your computations. And then for capex, which is fixed assets mostly, the assumptions also fit in to your workings, where you then calculate depreciation, calculate amortization, and so on. Once you've done your computations, those computations then feed into your output sheets. And there are three main output sheets: the income statement, the balance sheet, and then the cash flow statement. So the income statement takes in the income computations, the expenses computations, the interest charge computations from financing, and then the balance sheet also takes in the fixed asset assumptions, and then also the fixed assets, that's the assets, and then the financing, which is the share capital, that's equity, and then if you have debt also, those come into the balance sheet. Then for that's major, and then the cash flow statement takes lines from income statement and balance sheet to help you understand or know how much cash you have at the end of the period. So that's a brief recap. Sekina, has the document been shared now?
Yes, so okay. Please check the chat box. The link has been shared there. Please download and save a copy on your laptop. Do not work on the exact copy that has been shared. If not, other people will not be able to implement it. So please just download the link. But kindly confirm if you can download that link. Please check the chat section. Please.
This is a financial model template, and this has a lot of sheets. So when you're building your financial model, typically it has all these kind of sheets, right? But we're not going into the details of how these sheets got here. But if you want to know more about that, we'll talk more about that at the end of the course. So these are various sheets in the financial model, and the first sheet we are on is the cover page, which just tells us about about this document. So this document tells us that this sheet tells us rather that this is a financial model sprint webinar document, and then we'll be doing a model sprint. So if you are building this financial model for your company or for the company you work for, the logo of the company can be here, and then a picture of a product or something about your company can be here also. So moving on to the next sheet. The next sheet is the content page, which tells us about what is in this document. So the first is the cover page, which we just passed. And then this content sheet tells us that we have an input sheet in this document. We have a working sheet. We have an income statement sheet, statement of financial position, cash flow statements, and so on. Right. So from here, we can access each of these sheets by just clicking on this. So for example, if I want to click on this, it automatically takes me to the input sheets. So I'll go back to the content. I can also click this. It takes me to the income statement. So let's just continue on that. So moving on to the inputs. The input sheet is where we put in our assumptions as discussed. I'm talking about the inputs. The input is where you put in the assumptions, which ultimately drives everything in your model, right? So the input contains the income statement assumptions, the balance sheet assumptions, and so on. We'll talk about that in detail shortly. So next is the workings. So the workings is where we calculate and do all our computations. So all the computations on revenue, cost of sales, tax, debt, and so on and so forth. All those will be done here. And then, so this is the computation sheet. And finally, the output sheets, we have several of them here. The first we have here is the income statement, which contains the sales, the revenue, cost of goods sold, profit, and so on. And then we have the financial position, also known as balance sheet. So this contains the assets, that's the cash, current assets, fixed assets, and so on and so forth. And then we have the cash flow statement, which helps us to know our cash balance at the end of the year. And then we also have the analysis and dashboard sheets, where we can do some ratio analysis to see some metrics and then build a dashboard based on those analyzed metrics. So that's just a simple overview. I'm seeing some comments. So I'll just give another minute for people to download the document. And once you have downloaded it, please just say downloaded on the chat box. So I'll give another minute for that. So I guess people are already downloading this. Okay, so once you've downloaded it, please open on your desktop and then follow through as I walk. And then periodically I would ask for questions. I'll allow you to ask questions periodically. And then if you have questions, you can just drop them on the chat box. So I'll answer them immediately. And then if the question might take a while to type, you can just raise your hand and then take the questions periodically. Okay, so I'm starting now. So let's get started. So first, I'm going to start from the output sheets. So we need to understand what we have first before we even start building anything. So from the income statement, we have our sales number, which is, so let's take this company as a gala company to make our work easy and our life simple. So let's take this as a company that makes gala. So for sales, last year they made 75 million naira. They sold goods worth 75 million naira. And then the cost of goods sold last year was 37 million, meaning that 37 million naira was used to purchase the goods that was sold, and the goods, the raw material, labor, and everything. This is the number. And then we have a line for gross profit. So let's just calculate that quickly. So gross profit is sales minus cost of goods sold. So let's just do that. This is equal to this minus this. So this gives us our sales. So we had a gross profit of 38 million last year. And then for selling, so cost of taking the goods to wholesalers, cost of advertising and everything was 15 million last year. So minus that from the gross profit to get our operating profit, and that's going to give us the gross profit minus selling expenses. So we had an operating profit of 20 million last year. And then for taxes was 7 million. So we paid taxes worth 7 million last year. So let's calculate our net income by simply subtracting taxes from operating profit. And now we have our net income. So from this income statement, you can see a sales line. This tells us we need assumptions for sales. We need assumptions for cost of goods sold. We need assumptions for selling expenses. And then for taxes, we need to compute tax also. So these are the things we need to note that we need to calculate on our income statement. And then next thing is we'll go to the financial position. For the financial position, so for the financial position, we have the cash. So how much cash and cash equivalent? That was 12.5 million last year. So, and then current asset was 45 million. Current asset means the assets that are going to leave or assets that are mature in less than 1 year. And the example of this is the inventory, which are just goods in your warehouse. So galas we have in our warehouse, which probably not take a long time before we sell out. So current assets 45 million. So total current assets is going to be the sum of both of them, and that's going to be sum. And then we'll highlight both of them by pressing shift down arrow key and then close that. So let me just type that here for us to note to highlight cells. So to highlight cells, you press your shift key downwards and then you press the arrow or wherever you want it to go. If you want to highlight downwards, you press the down arrow key. If you want to highlight to the right, you also press the shift and right arrow key. So we have total current assets. So for fixed assets are assets that you have that are going to be with you for a long period of time. So you're going to have those assets for 5 years, 10 years, and then they're still with you. Examples are plants, machineries. So total assets will now be equal to sum, and then click on this, and for some formula, we can press the comma. The formula tells us press a comma after, so we press a comma after, and then we highlight fixed assets. So this gives us our total assets. And then for liabilities, current liabilities are liabilities that we need to settle within the next 12 months. So that's 30 million here. And long-term debts are debts that we don't need to settle now. We can settle them, or they need to be settled maybe in 3 years, 5 years. So they are long-term debts. Liabilities will be equal to sum, and then click on the current liabilities and then the other one also. So we can press enter. And then for equity is the sum. So equity, there are 2 lines here, share capital and retained earnings. So we need to have assumptions for share capital, assumptions for retained earnings, and now we can sum both of them. It's going to give us sum, and then we highlight both of them, enter. So looking at this quickly, we need assumptions for cash. We don't need assumptions for cash because cash comes from the cash flow statement. Current assets, we need assumptions for current assets. We need assumptions for fixed assets. We need assumptions for current liabilities rather. We need assumptions for long-term debt. We need assumptions for share capital and then retained earnings. So now, one key thing to note before we continue is the accounting equation. There's an accounting equation which is the asset is equal to equity plus liabilities. So your total asset must be equal to this for this accounting equation, which our financial model must also obey, right? So to see if our financial model obeys that, we can sum this up. So sum the total liabilities and then the total equities, and now we can check if our financial model obeys this by equating these two together. Is this equal to this? So it tells us true. So our model, both of them are equal. So this is fine. And now to check just to check our cash flow statement. So we have net incomes already. We have net income already. We have change in current assets. So we have we're going to have current asset assumptions based on our financial position. Same with liabilities. Same with this. So we don't need same with long-term debt. Same with share capital. So we don't need any new assumptions for any of this here, right? But there's something we need to do quickly before we continue. We need to link the cash at end of year to the financial position. We don't have it here. So we need to link to repeat that. So the cash at the end of 2021 is not on this statement, and we'll need that for our output here. So we need to link this to the financial position statement by pressing equal to, and then going to the SFP, you scroll to the cash place, and then link this quickly. So that's fine. And then there's one thing I should just explain here before we start building the input. So these numbers just looks bland. The zeros are together and it's difficult to read. Is this 12.5 million? Is this 125 million? Or is this 1.25 million? One useful thing that can be used to identify or know what this means, to make this written better, is to use sales styles. And sales styles are located on the Home tab. So you go to the Home tab, and then you go to the sales styles, under styles, and then Excel has already created styles for you, so you don't need to start wasting your time most times to do the styles. You can just scroll down to the styles and then click on comma 0. So this automatically puts the commas for you, and easily I can see that this is 12.5 million. All right, but sometimes I might be building my model and it might take a long time for me to come to Home. Rather than coming to Home, then trying to look for sales styles and then scrolling. An easy thing to do is to use a short code, access code, which you don't need to memorize. So an access code which is key, or which can be very useful and powerful, is using the Alt key. So I'll press my Alt key. Now, once I press my Alt key, we can see some letters coming up here. And then I know that my sales styles is under the Home tab, and under the Home tab, H comes up. So I just press my H, and then my sales styles comes up with a J. So I can just press a J, and then this comes up. So once this comes up easily, I can then click on what I want. Just to highlight that here quickly. So sales styles. For sales styles, use access code. Right. So this, you press your Alt key and then follow. By pressing your Alt key and following the letters that come up. So having said this, I'm going to start building the financial model now. So we've seen all the assumptions we need for this model. Now we're going to move to the input sheet and then start building. So I'll take one question now before I start. If there's any question, please raise your hand and my colleague will mute you. Just one question before I start building.
Abby, before you start, please, can anyone who has downloaded, can we just have like a Y in the chat, so at least we know that a couple of people have downloaded the file? Well, I know Mohammed has downloaded, Mustafa. Is there any other person that has downloaded successfully? Then please save as a copy. Do not work. I see some people working on the original file. Please save as a copy. Okay, Ifechuku has downloaded. Fantastic. All right. I think someone has a question. Let me check.
Okay, please go on with your question.
Mohammed has a question. Let me hold on, please. Just a minute. All right, so you can unmute yourself and ask your question.
Oh, okay, good. Thank you. Good morning, everyone. Good morning, Ms. Habib. Thank you very much for this presentation. My question is around the assumptions. I know sometimes when you're building your financial modeling, you used to have notes to the account where you put all the assumptions on the notes. I don't know whether if we're following that approach here too. Thank you.
Okay. So in this model, we're using the input sheets, right? For example, if you have an annual report for your model, the annual report will have notes, right, explaining each of those items in details or breaking them down in details. So let's say, for example, let's say the company sells food products, and then they sell a lot of products, let's say 10 products, right? you can easily lay out those historical numbers showing the revenue from each of the line item in a control sheet, and then from the control sheet you then link the sum of it to the output, right? But I'm not going to go into that detail here for this course, but I'll tell you how you can learn more about that at the end of this class. I hope that answers the question.
Yeah, okay, thank you. Thank you very much. Thank you.
Okay. So I wanted just one question at this time. So we'll continue now, and then periodically more questions can be asked. And if your question is urgent, you can just type it in the chat box. I hope we have this opened already and we're following through. Has everyone completed everything I've done? Okay. Has everyone completed these things I've done on the 3 sheets?
Oh, sorry, are we supposed to follow you as you're going through? Because I thought that will be a bit of distraction. I don't know what approach you want us to do here.
Okay, I would love it if you can follow me, right? That's the best. But if you want to just watch also and try it, that's fine. But I would love it if you can follow.
Okay, just give us a moment so that to be at fair with you. Thank you.
So I'll just give 30 seconds to 1 minute for us to open this and so that we can continue. Okay, so I'll continue now. So for yearly sales growth, we can see yearly sales growth from the income statement. We could see that we had an historical number for 2021. We made 75 million, and for the forecast year, we're going to build that based on sales growth. So we're going to see every year or in the forecast year, we want sales to grow by so and so percent, right? So for that, I'm going to put in how many percent I want it to grow by. From this, we can see that in the previous year, sales grew by 25%. So now we'll have to put in how much we want sales to grow by over the next few years. First, for me to make my input clear, I need to use a sales style so that it can be easily identified as an input. So I'm going to highlight where I want to do that by pressing Shift and down key, as I mentioned earlier, and then I'll press Shift and down key to the right also. And as I also talked about earlier, I'm going to use access codes to get in there by pressing Alt H G. Once I do that, I can then click on this input cell style under the data and model. I can also make it percentage. So most of these are in percentage. So I can, for my cell styles also, I can make this percentage by pressing Alt HG again, and then scrolling down and then pressing this percentage. So this automatically helps me helps any number by pressing come up in percentage. So for sales growth, let's assume that we want our sales to grow by 20% in the first year. We also want it to grow by 20% in the second year, then 25% after, 25%, and then 30%. So for the next one, cost of sales. For cost of sales, the driver for cost of sales here is going to be revenue. And that's because the amount of goods we sell is directly tied to the revenue. So if your revenue grows by 20%, the goods you sell has to be, so if you are selling 1 million, if you are selling 1 million goods, the 1 million goods, the cost of those goods is tied to the amount of revenue you make. So I'm going to tie the cost of goods sold to revenue. And we can see historically there was 49%. Let's maintain that 49%. 49%. So ideally we expect that it goes down over the forecast year. So let's say 48%, yeah, 48 again, and then let's make it 47, yeah. So for selling expenses also, the amount of selling expenses we're tying the driver, what we want to tie it to is to the sales or to revenue, because we want to say, so if you are selling 1 million amount, if you are selling 1 million goods, for example, you have to spend this percentage of money based on the goods you're selling. So we're tying it to revenue here. And then we can see that in the previous year, selling expenses was 21% of sales. Here, we can make it 20%, just to make it go down a bit. We can make it 20% and then maintain it. Let's maintain it as 20% over the forecast period. For taxes, also, taxes is fixed. Taxes is 32%, so we can make that 32% and then drag this to the right as 30%. I hope everyone is following me with this so far. So what you just need to do is put in these numbers as I've done and just follow through. So the next is the balance sheet assumptions. So for the balance sheet assumptions, let's also make the sales styles in inputs. And I'm going to highlight again by pressing Control and the down arrow key, as I mentioned earlier. And then I'm going to do that to the right. Then I'll press my access code Alt H J. And I'll then choose my inputs. So the next thing to do is to now forecast for the next thing. So current asset is, as I mentioned, the asset that you need to, the asset that you just have for a short period of time, just for 12 months or less. So in 12 months or less, those assets might need to be used to sell more goods. If it's an inventory, for example, you might need to sell those goods to customers, right? So current asset is tied to sales because it's tied to how much you sell, right? So over the forecast period, that's been 33%. We can say we can maintain 33% for most of let's okay. Before we do that, we need to make this sale. We need to make this first sale in percentage. So we need to do that quickly. I'll press my access code again, Alt H J, and then choose percent sales style here. So first I'll then press in my 33%, and then we can maintain this again for the forecast period. So for fixed assets is the assets that you have for a long period of time. So the assets are not like the current one where within a year they're going to mature and you need to use them for different things. But for fixed assets, they are like your plants, your machineries, which you have for a period of time and then depreciate over the years. So for this, we're going to be adding new assets year on year. It's not going to be year on, it's not going to be a percentage, it's new assets being added. So we're going to make this in naira, just an amount. So I'll make this 1.5 million here. So I can make this 500,000 here. Then I'll make this 750. I'll repeat 750 here. Then I'll make this 1 million. Then I can copy this to the right, and then I'll use the sales style with comma Alt HJ, and then I'll choose the one with comma. So for current liabilities, these are liabilities that we need to settle within the next 12 months or less. So examples of this is short-term debt, right? And then trade payables. So for current liabilities, we can, so this over the years, it has been 65%, and this is where the historical analysis help you. So based on the historical analysis, it was clear that cost of current liabilities was 65% of cost of goods sold. So we can then see that over the forecast period, we want it to, we can say, okay, let's maintain it for forecast period. But first, we need to make this sales staff percentage again. So I can highlight this Alt HJ and then choose percent for this. So we can make this 65 also, and then just copy to the right quickly by pressing Ctrl R. So to copy to the right, you just press, you do this, then you highlight the cells that you want to, you highlight the cells, you shift and arrow key, and then you press Ctrl R to copy to the right. If you wanted to copy downwards, you highlight downwards and press Ctrl down. But we're not doing that, so I'll just write that down here for us so that we can take notes.
Habib, Mohammed had a question. He had his hand up, so I don't know if you want to take it out now.
Okay, Mohammed, please continue.
I think we can go on. I'm fine. Thank you. I got it now. Thank you.
Okay. To copy to the right, you press Control key, and then R button. To copy down, so rather than typing it typing it a number of times, you can just press Control key and then V. So that helps you copy the number downwards. So we can continue now. So for long-term debt, so this is a yearly balance. So yearly balance means at the end of the year, how much debt are we going to have? The closing number. So let's say we've taken new debt, we've paid some. At the end of the year, how much do we have in debt? So let's say in the first year we have, let's say, okay, let's change this from percentage, and then, okay, let me just copy this here. So to change it, so let's say at the end of the first year we have 35 million in debt. Then let's say we have the same in next year, and then let's say you increase it again to 38, and then and then it just maintains at that over the focus period. For share capital also, so this is the NERA value. This is the value at the end of the year also. What's the share capital value? So for share capital, let's rather than make it that, let's make it. Are we taking any new share capital? Rather than making NERA, let's make it NERA value. That's fine. But let's do it in a way where we can have additions. So let's make it. Okay, so for the share capital, we had 10 million in the historical. So let's just do this in an addition format where let's assume that it's still going to be 10 million over the, let's say, okay, let's make it an addition star. So in the first year, let's say nothing is raised. Next year, nothing is raised. Then let's say in the next year, 5 million new capital. And then nothing else over in the next few years. So I can then change this to I can add the comma here and then put percentage here. Not percentage, what's HJ? So comma. Okay, so we're done with the inputs, right? But I know some people might still want to copy this into their sheets. So I'll give you 4 minutes to copy these things, to write these numbers in your own spreadsheet quickly. So I'm up now, so you can start copying from here, and then once you are done with this, let me know in the chat box. I'll scroll down. It actually takes everything. So these are the assumptions. So let's copy this into our sheets in 3-4 minutes. If you have any questions, by the way, you can ask now whilst others copy. If you have questions, please raise your hand, and then okay. So I'm going to just talk about some key things now.
Bashir has a question. Please unmute yourself, and Ifechukwu, please unmute yourself. One after the other.
Okay. Could you please make the long-term debt yearly balance? Can you please make it in accounting format so that we can be sure? Because I don't know if this is 35 million or 3.5. Like I can't really
that's
see.
fine. Okay, that's fine. So let me just talk about sales styles again. So sales styles help you to do it easily. So when you're typing in numbers, rather than wanting to type the commas or doing it in another kind of way, which might be code, an easy way to do it is by using sales styles. And sales styles is located in the Home tab. So I'll just show that quickly by going to the Home tab. So in the Home tab, under the styles section, an easy way to do that is to go to the sales styles, and Excel has come up with a number of styles for us where we can use to easily put in those things in our numbers without having to waste time. And for this one, which someone just mentioned to me, it doesn't have commas, right? I want it to have commas, which is accounting standard. There are a number of number formats here, which Excel has done for us. So I'm going to use the comma 0 to make it have commas, right? But there are also other commas here. There are also other formats here, rather, such as the percent format, right? But so if you wanted the numbers to have percentage, for example, you can just click on the percent and then the numbers come up in percent format. But for this, we want it to come up in comma. So we're going to click on this and then this comes up in comma. So I hope this answers your question.
Yes.
Okay, so second question.
Okay, so first I'm just confirming that the additional share capital is 5 million. And furthermore,
okay, thank you for that.
The copyright, I don't know why my own is not doing for it, just copyright cell by cell. I cannot do it for a range of cell. I don't know whether I'm doing the right thing. But it's just working for just a particular cell.
Okay, so let me do that. Let me do that again. So you can just look at what I'm going to do. So let's say for current assets, I have 33% for the first year. And I want to copy it. I want everything here for the next 4 ones to be 33%. So what I'm going to do is I'll press my shift key and then the right arrow key to highlight the cells. So can you do this now? Let me know when you're done. Done?
Okay, yeah, I think because I was just starting from the next cell, not the.
Okay, so once you're done, then you can press continue. Yeah, all right, cool. Okay, so let me just talk to yeah, and
we can move on. One last question.
Okay.
Yes, answered my question already.
Okay, all right. So you can lower your hands so that it's not confusing. Thank you.
Okay. All right. So I'll just talk about one more thing. So Ikechukwu, did you have did you put these cells, these blue cells in your work?
Yeah.
Okay, so let me just explain it again in case some people didn't get it. So these blue things are just a way to help you differentiate or help you know that what is in this cell is an input or an input assumption. And to do that is also in the cell style. So you just highlight wherever you want that to be. Go to the Home tab, go to the Cell Style tab, and then choose this input under the data and model. So I hope has everyone been able to compute all this? Please just send yes to the chat box. I just need a few one. Just send yes if you have all these inputs in your spreadsheet now. Send yes in the chat box. Okay. One more person. Please send yes to the chat box. Okay. Okay, people are following. So now let's go to the workings now. So for the workings, one thing that is important is that your work has to be structured. So the way we've done the input now, if someone is going to open this and try to read this, once the person opens this document first, they can see this sheet saying input and assumptions. Someone is asking, can only work on it on SharePoint. Can you make your question clearer? So income statement as okay.
Shay, what you need to do is go to file and save as a copy. So that way you're able to download the file basically. So save as a copy and save on your desktop. I hope that's clear. Habib, you can tell.
Okay. So now one thing that's clear from the input which you just did is once someone comes here and he hasn't seen this document before, you can see clearly that this is the input and assumption sheet. And then you can now see the income assumptions clearly. And then you can see the balance sheet assumptions also all laid out clearly. The input and assumptions is on column A rather, and then the income statement assumption is on column C, and then the others are column D. So this is a structured way of typing out your assumptions so that it's easy to read them and it's flowing in a clear manner. So we're going to follow this order on our workings also. So our working sheet is blank, so we need to compute this ourselves. So first thing I need to do is we're going to start with the input assumptions. So these inputs, I'll type in my input assumptions. Yeah. And you can type as I type. So once I type in the input assumptions, then for the input assumptions, the first one we add is income statement, not input. So I'll change that. Income statement assumptions. So for income statement assumptions, the first one we add here was the first one that is here is the yearly sales growth. So that tells us that we need to have the sales assumptions first. So let's link it from, let's just type it sales. So this is sales assumption. That's the first assumption we need to have. And then we can see on our sheet that the sales is in green. So this green tells us that this is a forecast. Right, we need to forecast our assumptions here. So in the inputs were in blue, and now the working sheet is now in green. So this helps you to understand that this is a forecast or a forecasting here. So for the sales, the driver of sales is sales growth, and that tells us that year on year our sales is growing by 1%, right? And then for this, the first thing we need to do, since it's growing on previous, we need to bring in the historical sales value here. So to do that, we'll press our equal to, and then we go to the IS and click this. So once you do this, this is sales value for last year, and then we can easily put our commas by going to our sales style and then choosing the commas here. So our sales is growth, so we're growing this by 1%. So we need to write a formula to tell us that grow the historical number by 1%. And to do that, I'll press my equal to, I'll choose my previous year number. Then I'm going to first multiply this by 1 plus the percentage, which is 20%. And then I can close this. So this gives me my revenue for 2022. So the revenue is going this 20% plus last year's number. Okay. So I'm going to talk about the cell references now quickly. So you can see normally I'm going to, as I'm working on this, there are different ways. So for example, let's say I didn't want this to go. Let's say I just wanted this to multiply a number. Let's say this was here, for example. Let me put this here just to show how can I do this. Okay, so I want to talk about cell references now. Yes.
Please go through.
Is there a question?
That yeah. So Bashir is trying to figure out how you got the number, the 90 million. So maybe you want to go through that formula again.
Okay, so I'll do that again.
No, sorry. I wanted to know how he got the 75 to 70 figure. 75 billion, 270,000 naira figure.
Okay. Okay, so I'm going to do that now. So to do this, so the first thing to do is to explain what we're trying to do is to grow the sales number. And this is what we're trying to say is sales for last year was 75 million. And sales for this year is going to grow by 20%, right? So sales for 2021 is going to be 20% growth of last year's sales, right? I hope that's clear. So to do that, the formula we're going to write is last year's sales times 1 plus the growth. The 1 is going to give us the last year's number, and then the plus the historical number, the percentage you're going to have here is going to give us the amount or the percentage we want that number, the revenue of last year to grow by. Is that clear? I'm just explaining it first. Is that clear? Please unmute yourself and answer.
No. Yes, it's
okay. It's not clear. So let me explain it again. So so for last year we made 75 million in sales, and then this year we want to sell, we want to make 20, we want to sell 20% more of what we had last year. So we need to write a formula to tell us that calculate last year's number, or calculate 20% plus last year's number. So the formula I have to do is going to tell, we need to write a formula that will tell us. So let's say last year's number was 100%. Let me write 100%. Yeah. So last year's sales is 100%. So we want to write for 2022, we want the sales to be 100%. So let me write this equal to, let me open it back. Let me just do it small. So we want sales to be 20%. So sales is going to be this plus, so sales is going to be 100%, that's last year's value, plus 20%, which is what we want it to go by in this forecast year, right? So we can put this in brackets. So this last year's 100% tells us that last year we still want to make last year's sales, and they want to make 20% of last year's sales plus that. So we now multiply this with the value of the sales of last year, and this is this. So we can type. So this is how I came about that number. I'm just explaining it here. I'm going to type it. So this how to do. So this is the first step. So now I hope this is clear first. I hope this explanation is clear.
Yes.
Okay, now so let's write it in forecast. Let's now write it here. So to write it here, rather than write 1% or 100%, if you're writing it without percentage, 1% is also the same thing as 1, right? 100% is 1. So I'm going to use 1 instead of 100%. And then I'm going to, so we can see that the forecast is on column M here. So I'm going to type equal to, then I'm going to open a bracket, type this 1, then do plus. So I need to put in the historical number for year 1. And I can see that 2023 is on column M. So I'll go to my input, go to column M on yearly sales, which is 2022, also column M, and then choose the sales value on column M for yearly sales, and then close my bracket. So I'll go back to my workings now, and then multiply this with the last year's sales value, which I just did here now, not long ago, and then press enter. Is this clear?
Yes, my original question was, how did you get that 75 million to 70,000?
Okay.
Like,
so
did you type it in there?
I didn't. Okay. I didn't type it. I linked it from the income statement. So this sales value is this sales here. Can you see it from the income statement? So I just went to the workings and then typed in my equal to, then go to my income statement and choose sales. And I did this here. Do you understand that now? Okay, so I just did this. I wrote it in this format to explain, right? So I'll just write it in the right format quickly. So in the right format is going to be equal to the historical number times 1 plus the last year's percent, which is on column M also, right? And then I can enter that. So this is clear now, I expect. So now we've done the forecast, we've done for. So one thing again, rather than dragging to the right, so for the input, so I was dragging the inputs, right? But for the workings, it's better to do them first for all the years and make sure your first year balances before you now copy it, right? So we're going to follow that principle here. So now I've done for sales. Is someone trying to say something? Okay, so I'll continue.
Okay,
so
can you hear me?
Yes.
Okay, please, I would like to know whether this class is being recorded and it will be shared to us.
it's being recorded, but please try to follow as much as possible and ask questions here. But it's being recorded and to be shared with you.
Okay, thank you.
Yeah, and then second, can we mute everyone? And then if anyone has questions, they raise their hands.
Everyone now, and if you have a question, please type it in the chat box so that we don't slow the class down. Thank you.
Okay. So I'll continue now. So I've done for sales. So next thing from following this order, which I mentioned is important, is we need to calculate for cost of goods sold. All right, for cost of goods sold, we mentioned earlier that the driver is percentage of sales. So the cost of goods we sell is a percentage of how much revenue we make. Last year it was 49% of revenue we made, and then for this year we're saying it's going to be 49% of what we sold. So cost of goods sold is 49% of the revenue of last year. So to do that in workings, I'm going to come here and type cost of goods sold. Then cost of goods sold. So it's going to be equal to, I'm not going to bring in any historical number like I did here. I'm going to just do equals to, so we're going to do the percentage, which is, so cost of goods sold is 49% of sales. So 49% on column M for 2022. Please choose column M, the first column. And then I'm going to multiply this percentage by the sales we just calculated now. And then press enter. So this gives us the cost of goods sold value. So next thing for me to calculate is the selling expenses, which is also a percentage of goods sold. So for selling expenses, that's going to be, selling expenses is going to be, I'll type that here quickly. And then once I've typed this here, I can then, so selling expenses is a percentage of goods sold, just like cost of goods sold. And then we can see that for the first year, selling expenses is to be 20% of goods sold, right? So we're going to come to the workings and then say equal to the percentage, which for selling expenses, that's 20% times the cost of goods sold, which is, let me do that again. Selling expenses is equal to the selling expenses percentage, which is 20%, times the sales value, which is 90 million. So that gives us selling expenses, and then we can make that comma. Okay, so next is to calculate. So next assumption we need to have, or next workings we need to do, is the taxes, right? And for taxes, so we'll do taxes here. So for taxes, the formula for taxes is profit before tax times the tax rate. So that's for profit before tax. We have the operating profit in our case here. So taxes is operating profit times the tax rate. So for the historical year, we have to calculate the operating profit in our calculation, and then we now multiply that by the tax rate, which we have here as 32%, right? So the operating profit, the formula for the operating profit, let's just follow this. Let's follow what we have here. So operating profit is sales minus cost of goods sold minus selling expenses. So that will give us the operating profit. And based on our calculations so far, we have a value for sales, we have a value for cost of goods sold, and then we have a value for selling expenses. So we're going to do that calculation in a bracket now, and then multiply that with the tax rate. So that's going to be equal to sales. So we'll open a bracket first, and then we'll say sales minus cost of goods sold minus selling expenses. So we'll put that in, we'll close the bracket, Once we've closed the bracket, we'll then multiply this. I'm put the multiplication first or after. That's anyone. You can say, you can go here, come to the input, choose the tax rates on column M for 2022, and then just put the multiplication sign initially and press enter. So this gives us our tax value for 2022. But I've been going to the cell styles on and off severally. Instead of doing that, another thing I can do is to just copy the cell style from a previous one I've applied it to. So to do that, I'm going to use something called paste special. And paste special is, I'll do that first and then type it out. So paste special, to use paste special, I'm going to copy this cell first by pressing Ctrl C. I'll then come to the cell I want to apply it to, and then press Alt Ctrl V. So a dialog box comes up, and from this dialog box, I can then copy the formats. So I've clicked on formats. Once I've done this, I can now press my OK, and automatically the previous cell styles here is applied without me having to go back to that place. So I'll just type that here for us quickly. Okay, so then before you use the paste special, you have to copy first. You have to copy the first cell. Copy. You have to copy. And then after you've copied, you then once you copy, so for this our example, we've copied the cell with the cell format that we want to apply, and then we paste special by using this. Once we paste special, we then choose the format button. So we're done with the workings for the income statement lines. So I'm going to give us, so if you have any questions now, please unmute your mic and then ask your questions in the next 2 minutes, 2 to 4 minutes. And you can also try and compute all these things I've done quickly before we move on. I'm mindful of time now, so just if there's one question, let's have that.
Sorry, I had a little bit of network glitch when you were calculating the taxes. Can you please run that through again?
Okay, so I said for taxes, I'll just go to my income statement sheet again. So for taxes is operating profit times tax rate. For the operating profit, the formula for operating profit is sales minus cost of goods sold minus selling expenses. That's the formula for operating profit. So from the workings, we've calculated our sales, our cost of goods sold, and selling expenses. So the first thing you do is you press your equal to, and then you open you press your equal to, go to the input cell, click the tax rate for 2022, which is on column M, and then you press your multiplication sign table, your multiplication sign, open the bracket, go to your working sheet. Once you've got into your working sheet, press your sales value minus cost of goods sold minus selling expenses. You can then close that bracket and press enter. Is that clear?
Yes, thanks.
Okay, so I'll move on. Okay, so I'll move on to the balance sheet assumptions quickly. So I'll leave a line actually, and then press my sheet balance. Let's use balance sheet. Okay, let's just be consistent. Statement is going to be consistent when you're building model statement of financial position. So we can then start that quickly. So for the input, the first assumption we have here is the current asset. And for current asset, we said current asset is a percentage of sales. So if sales is X, then current asset is percentage of sales or percentage of X. So for our case, current asset is 33% of sales. So we'll do that quickly. So current asset, we type in our current asset here. And then once we've done this, we can then type in equal to. So we'll go to so this column M, we'll go back to current asset, go back to this sheet, press our percentage multiplied by this percentage of sales. So we go back to our workings and then press the sales value here and then press enter. We'll apply the previous sales style here by pressing, we'll copy this cell first, Ctrl C, come to the current assets, press Alt Ctrl V for paste special, and then we'll paste formats. So the next one we have here is the fixed asset. So fixed asset is never growth, meaning if you have, so last year we had 1.5 million. So this tells us that in the new year, 500,000 is going to be added to the fixed asset pool, and the next year and so on and so forth. So for fixed asset, we're going to say, we'll leave for fixed asset because we're going to have much lines. Let's leave a line and type fixed asset here. So let's bold in this because it's going to, let's just bold in this. And then we're going to, so for last year's value or for fixed assets, we're going to have an opening line item, which tells us at the beginning of the year, how much do we have in fixed asset pool? And then in the new year, how much are we going to add? So what we're adding is usually the capex. How much capex are we buying in that new year? That's the addition. And then the reduction is how much is the depreciation. Reduction is also depreciation value for the current year. And then we then have the closing after. So the closing is telling us at the end of the year how much we have left. So for this, for fixed asset, the formula for calculating the closing is the opening plus the addition, then you subtract the depreciation from it. So to make this neat, I'm going to put a line on top of this cell. To put a line on top of this cell, there's something called borders, and the borders is under the Home tab. So I'll go to the Home tab now, and then this is the borders here in the font section. So I'll click on this drop down. I want a top border, so I'll choose top border. So that comes up with a line on top. The cells are highlighted. Okay, so that's done. So now we need to do this quickly. So what I'll do here is for the closing balance, I'll go to the SFP here and then choose this 70 million. Yeah, so this is the amount we had as at the end of last year. So I'll come to the workings and then choose the closing, how much we had in fixed asset at the end of last year. That was 70 million, 70.8 million. So I'll choose that. And then I'll go to the opening. For the opening is equal to the opening of the new year is equal to the closing of the last year. And then the addition is the assumption we have on our input sheet, which is how much capex are we buying in the new year. So I'll go to the input sheet and then choose that. That's 500,000 here. So for our case here, I'm not going to use depreciation in this class. But if you want to learn more about that, I'll let you know how it can. So for the closing now, this closing is telling us at the end of the year, how much are we now going to have in fixed assets. So this is going to be equal to the opening plus addition minus depreciation. So from this schedule, what's going to enter the balance sheet or the statement of financial position is this closing balance value. So let me just type it clearly here, closing balance. Okay, so I'll apply the sales styles again. Yeah, I can apply it here too. Okay, so we need to change this to, let's make this normal. So let me just actually do this again. So copy this, come here, paste special, and then you're pasting the format. You're pasting the format, right? So we can paste that. It's coming up with it. So let's just make it normal, and then see. Okay, so we're done with this. We'll move on to the next assumption we need. I'll give time for us to copy this once I'm done. So for current liabilities is the percentage of cost of goods sold. So cost of goods sold is, so this is similar to what we've done previously, this times cost of sales. So we'll put current liabilities on a new line here. Current liabilities is, so let's extend these forecast lines. So current liability is the percentage of cost of goods sold. So let's choose the percentage on column M, 65% times cost of goods sold. Scroll up, 44 million, and you press enter. We can apply this sales style again. So next assumption we need is the long-term debt. So the long-term debt is just a yearly balance. So we'll just put a line for this quickly. For long-term debt, we're just going to pick the input value quickly. And then this gives us this. So you can apply the sales style. Then finally, we have the share capital, which is an error value, but I've tweaked this a bit to make it addition. So we're going to have the ending value, and then we're going to have 5 million added in share capital by forecast year 3. So let's have share capital assumption here. I'm leaving a line in between. I'm going to first this as bold. So I'm going to have the opening. I'm going to have the addition. So in our case here, for share capital, the addition is the net income, or which can also be called profit at the end of the year. Okay, no, this addition is just, that's for retained earnings actually. So addition is how much share capital you're adding into the business, right? And then reduction, we then have the reduction, which is really, so we can just leave it as addition for this case. And then we can have a line on top, Alt HPP quickly. And then we have the closing here, closing balance, which goes to the balance sheet. So for the closing balance for share capital, that's going to be equal to, we'll go to the financial position, scroll down, and then choose our 10 million. For the opening, that's also the opening. And then for the addition comes from our input sheet, which is going to be equal to this, which is 0 for the first year. So we just link this. And the closing balance is going to be equal to this plus this. So we can apply our sales style to this. Go to the let's use our code, Alt HA, and then press comma. So we're done with this. So we're done with the assumptions here, but there's one more thing we need to do, and that's, so for you to know, for you to know if there's anything left. We've done assumptions for sales, cost of goods sold, selling expenses, and tax. But if you come to the financial position, you realize that we don't have assumptions for retained earnings yet. So we need to do that on our workings. So we have retained earnings here. So we type in, and that's going to follow the similar format, a similar format to fixed assets. For retained earnings, we're going to have an opening also. We're going to have addition, which is the net income. And then I'm going to have reduction, which is dividend paid out. And then we have our closing balance. So same thing, we can put a line on top by pressing our code Alt H. Then our border where our border is coming up with a code named B. So press B. And we want a top border, so press P. So for our retained earnings, the closing balance is picked up from the financial position. That's 53 million. So that's also our opening balance. And then for addition, our addition is our net income, right? So for our net income, we can just pick that from the income statement, which is going to be we don't have that yet, but we can link that here quickly. For dividends, we're not going to cover that in this class, but if you have dividend assumptions, you could compute that and do that here. For our closing balance is going to be equal to opening plus net income minus this, and this gives us this. So we can put the sales style, have the sales style quickly. And then we're done with the computation for this. So we're done with the balance sheet assumptions now. And that brings us to the end of the workings assumptions. So if is there any question here? Is there anything you want me to show the formula? Please raise your hand in the next 1 minute so I can walk you through that. Questions, please raise your hands.
You can unmute yourself.
Okay. Hi, Habib. I'm just confirming something. So for the profit, when you were calculating the retained and the profit from the year, do you take it from the income statement or you took it from your working? I know it's not.
I took it from my income statement.
I took it
from my income statement. But we can also, I take it from my income statement, yeah. But if we wanted to take it from our workings, let's take it from our workings, for example. So to take it from our workings, we're going to say equal to, we'll just do, to take it from our workings, we'll say equal to sales minus, since we know our formulas, we know all the formulas, we're going to say equal to sales minus cost of goods sold minus selling expenses minus taxes. So that will give us our net income easily. So this is our net income. So this is one way, or once it calculates on the output sheet. So this is another way of doing it, and I think this is fine also. So if I'm sure we're following me, right? So if I'll scroll up so we can follow through, and then if there's any formula you want me to show you so that I can type this in your spreadsheet, please let me know in the chat box. So I'll just give us 2 minutes to catch up quickly. If you have questions, please raise your hands or let me know in the chat box. Questions, comments, please raise your hand. Questions? No questions? All good? Okay, so I'll move on to the income statement now. So for the income statement is basically us just linking the numbers we got from our workings into this sheet. And for the first one, we calculated for our sales. So we come here by pressing equal to, go to our working sheets, and then we choose our sales value. For cost of goods sold, same thing. We've done the calculations here. So we come here and choose the calculated value here also. So let's do for selling expenses, press our equal to, we go to our working sheet and then click on selling expenses, then enter. For operating profit, same thing, equal to, go to the selling, so taxes rather. So I'm going to the taxes rather. For the taxes, I'll press my equal to, go to the workings, and then press enter. So next thing for us to do is to calculate the ones that don't need to be brought from the working sheet. And we already have this, we already have some formulas on the historical column. So rather than typing the formula again, we can just copy to the right by highlighting 2 cells and pressing Ctrl R. Next one, we highlight the 2 cells, press Ctrl R. Finally, highlight the 2 cells, press Ctrl R. Any questions? Okay, so I'll move on to the financial position quickly. For the financial position, for the cash comes from the it should be entered last because it comes from the cash flow statement. So we're going to leave that for now and then go to the next one. For current assets, because we have calculated something on the working sheet. So go to the working sheet and then click current assets here. So for fixed asset also, we have something here. So come to the working sheet and then choose the closing balance for fixed assets. For liabilities, for current liabilities, we calculated something also. So we press R equal to, go to the working sheet and then click on current liabilities here. For long-term debt, click out. We also calculated something for this. So we're going to press R equal to sign, go to our working sheet and press enter. Finally, the last section here, we're going to, for share capital, we had some assumptions. So we're going to press R equal to sign, go to the share capital, and then press enter. For retained earnings, same thing, equal to sign, go to the working sheet, and then we press enter. So let's do that quickly in 2 minutes. Let's link all the numbers from our workings. If you have questions, please raise your hands. If you are following me, please type yes on the chat box. If you have questions, if there's anything you want me to walk you through, please let me know.
If you're following so far, just type a yes in the chat so that we know that you're following. Yeah, Rahim says yes.
Okay, so my own question is not concerning this. Like the examples you are using is for profit making. I work with a non-profit making organization, so I'm kind of lost in between all this.
Okay, so for your non-profit, I suppose you have donations from people, right? And then what matters if you are preparing a model for a non-profit is knowing your assumptions. For example, how much do you expect to get? It might not be as complex. How much do you expect to get from? So this example is for a business, right? So if you are doing for a non-profit, what you need to know is how much donations do you expect to come in the forecast years? How much are you going to spend? And then you can do a cash flow statement to show how much are you going to spend at a period of time, and then how much are you going to get in to know how much cash you have at a period of time. So that's still basically the idea. But if you want to learn more about it, right, there's somewhere I'm going to recommend to you at the end of this course where you can go into and learn more about models for all sorts of entities.
Oluwaseun says, how do you write the dates?
The dates.
Yeah.
So for you to write these dates, we're not covering that in this class. But if you want to learn about that, there's also somewhere I'm going to recommend to you at the end of the class. So just hang around till the end. Okay, so we're done with this, right? So let's just copy our formulas to the right. So I'm going to highlight this, Ctrl R, highlight this, Ctrl R. Same thing here, Ctrl R, and then Ctrl R here. Finally, Ctrl R. So our model is not balanced, and that's because the cash has not been calculated. So for us to calculate the cash, I'm going to go to the last sheet here and then calculate this quickly. For the cash flow statement, this is going to be a bit different because we're not picking anything from the workings for this one. For cash flow, we're just going to calculate the difference between two things most of the time. So I'm going to start with the operating activities. For cash flow statements, there are three main sections. The first is the operating activities. So for cash flow statement, so you have the operating activities where it contains cash flows from your basic business operations. So your net profit, your current assets, change in current assets, change in current liabilities, all this comes in your operating activities, the day-to-day operations of your business. Then you have the investing activity. So the investing activities this talks about so if you are buying PPE, if you are buying assets, this comes here. So you are calculating the amount of assets you are buying, or this comes in, and if you perhaps want to sell assets too, it might come in here too. And then finally, I have the financing activities. So the financing activities talks about the amount you need. So if you need to get loans, or you need to pay loans, or you're issuing share capital, you're paying dividends, all those comes up under the financing activities in your cash flow statement. So for the net income, you can pick this from the income statement quickly. So the net income at the end of the year, you pick that here. For changes in current assets, the formula for this is the current assets last year minus the current asset this year. So our last year is the historical. So we'll go to our financial position. So I'm going to say last year's current assets minus this year's current asset, and then we press enter. For current liabilities, it's the opposite. So you're calculating the liabilities you have currently minus the liabilities you had last year to see how much liabilities you now have. So this is going to be equal to liabilities. We'll scroll down to liabilities, and then we say this minus last year's liabilities. This comes up with a minus, right? So this telling us, the minus tells us that what money is going out of our business. That's what this minus tells us. And the positive tells us that money is coming into our business. So we can use the comma cell style here, press our code, and then we choose our comma. So moving on, so let's just sum this up quickly. So this is sum of these three. For the next section, which I explained not long ago, investing activities, we are calculating the change in fixed assets here. And the change in fixed assets is just how much assets are we buying, how much asset have we bought in the new year. So any asset we are buying means money is leaving our business. So this has to be minus because money is leaving our business as we're buying the asset. So we press equal to, press our minus sign, then we'll go to our working sheet and then scroll to fixed asset section, and then choose this. So this comes up with a minus sign, and then it's still equal to the previous one. So next is we go to the financing activities section. Let's make this with commas quickly. In the financing activities, the change in long-term debt is going to be equal to the debt we have now minus last year's debt, right? So that's similar to liabilities. So I'm going to say equal to, we then go to the financial position sheet, long-term debt minus this, and then press our enter. Same with the share capital, equal to, go to the share capital sheet, equal to this year's share capital minus last year's share capital, and then press our enter. So we can sum this up quickly. Then use our sales styles. For cash generated in the year is a sum of the cash flow from the three parts. That's the cash flow from operating activities, investing activities, and financing activities. So we're going to say equal to sum, and then we can scroll up to that part and then choose. So we choose this first one, choose the second one, and then choose the third one. We can close our bracket after, press enter. So cash balance is still the same thing as this. Press our enter. Cash at the beginning of the year is cash at the end of last year. So you press our equal to sign and then enter. So cash at the end of the year is a sum of cash balance and cash at the beginning of the year. So that's going to be equal to sum of both of this. And then we can press our enter. And finally, before you can ask your questions, we need to link this cash balance to the balance sheet. All right, to do this, I'll go to my balance sheet, go to the cash section, and then press equal to, I'll go to my cash flow statements, press this and enter. So if I was to go to my balance sheet, it tells me true, meaning this balance sheet is balanced, and it follows our equation, our accounting equation of assets equal to equity plus liabilities. So I've covered a lot over the last few minutes. So I'll go back to my cash flow statement now, and then you can check what I've done. I can scroll to anywhere you want me to scroll to. And then if you have questions, please ask over the next few minutes.
Bet you could please go ahead.
Sorry, Happy.
Yes.
How did you do your audit check balance? That's true.
Okay. So for my balance, I'll repeat this one again. So for the balance, the formula is, you say you're trying to check if the accounting equation is true. And the accounting equation is assets equal to equity plus liabilities. So your asset is total assets. So you're going to equate total assets with equities plus liabilities. So go to our, so let me just implement this quickly. So you're saying equal to, you then go to your total asset. Total asset is this 148 million. So I'm asking Excel, is this equal to, then I press my equal to again. Is this equal to total equity and liabilities and total liabilities and equity? So I like the second one and press enter. So that gives me true. Okay. Any other question?
Is that clear, Ifechukwu?
Yes, it is. Thank you.
All right. Any other questions for us? Are you guys following? Who did we lose? Okay.
Please,
are we all following?
I hope it has been exciting so far. I'll wrapping shortly. Any questions? Should I go back to my, where do you want me to show the workings on the cash flow statement? I hope it's clear.
If it's clear, please put a thumbs up. Okay, Oluwaseun says, what are the workings for finance cost?
Finance cost. So we don't have finance cost in our model here. But finance cost means interest expenses, right? And interest expenses come from your debts calculation. So in our model here, we have long-term debt as a yearly balance. But let's say we wanted to calculate our finance costs. We can have an assumption for finance cost rate or interest. We can have an assumption for interest rate. So let's say we have an assumption for interest rate here. Interest rate. So the interest rate for the loans we get. So we can say the interest rate. We can say the interest rate is. So let's say the interest rate is 27% on every loan, for example. 27%. Let me copy this. So let's say the interest rate is 27%. So this, to calculate the interest expense for this year, we'll then multiply the long-term debt with the interest rate percent to get our finance cost for the year. We're not doing this in this model because it's a very simple one. Any other question? Okay, so if there's no other question, if there's no any other question, let's finalize this by copying these formulas to the right. So calculated for the first year, and as I mentioned earlier, when you're building financial models, it's best to copy to the right. Right. So I'm going to highlight this down by pressing Ctrl Shift down arrow key. So I keep pressing Ctrl Shift down, and then once I'm done with this, I can then press my Shift key and the right arrow button up to where I want to copy the formula to. So I'm on the working sheet now, and once I've done this, I can press Ctrl and R to copy to the right. Now I've done this, so this automatically shows the sales value for the next few years, cost of goods value for the next few years, right? And then now that this is done, the next thing to do is to go to the income statement sheet and then also copy this formula on the first year to the right. So I like this. I like this to the right. So I'm working from left to right, left, right. So I'm going to copy this to the right. And then I'll go to the financial position sheet. I'll copy this. I'll copy this to the right. And then, so the cash is showing 0 because the cash comes from the cash flow statement and we haven't dragged that to the right. If you were to check the balance check here, you see, okay, let's copy this to the right also. You see it says false because the values are not equal. But once we drag the cash flow to the right, comes up as S. So let's copy this to the right. And then this comes up as true, right? So I know for the analysis and dashboard, a lot of people there. So this ones we'll be doing so far is useful, but what is more valuable when you're trying to show someone wanting to put money in your business, or if you're a finance person in a company, once you start working, the management or your manager wants to see a brief overview of what all these things means. So someone is coming in and is saying 47 million, 69 million. It might not really understand this because it's a whole lot of numbers and you can't see any trends on these numbers. So one powerful thing to do when trying to understand this output, you want to understand your income statement, your financial position, your cash flow statement better. Something that is very powerful and what the management and even you would want to see to understand your business better is the analysis, which contains calculating ratios and then seeing the breakdown of different components in your sheets, right? So once you've done the analysis, typically you then try to put those numbers in a chart and in nice styles where someone can just come in and read that and then based on that understand everything your input, your workings, your income statement has been saying all along, right? And that's something that is always very useful and will also be useful for you, right? And if you want to see some tricks and what the impact will be on your business, you just need to come to the input sheet, tweak some assumptions, go to your dashboard, and then you can see the impact of that change on your revenue, on cost of goods sold, on your profit level, and so many other things, right? And that's really the main thing, or that's where you can really see or enjoy the value of your financial model. And that's where it comes in handy for you as a business owner for the manager of your business. If you're working for your managers, management of your company, if you are trying to raise capital if you are trying to acquire a new company or whatever, your business needs to understand that business by looking at dashboards and doing thorough analysis of these output sheets. But we'll not be covering that here in this class because of time. But I know most of you want to learn about that, and you also want to learn. I remember someone asking a question on how these dates were formed, and also these sheets. How is this sheet color red? How is this color green? Someone might want to ask that question, or how I was able to copy this and click on this to cover page. So there are a lot of things that has not been explained in this class. And that's also one of the most important things you need to learn as a student moving in to your finance career. So my colleague will come up now and then talk about that quickly. Or if you have any questions, please ask your questions before my colleague talks about that.
Alrighty. Any final questions? So, okay, so I think I'm just going to go right into it. So, okay, Shope has a question. Shope, please unmute yourself.
Yeah, hi, Sekinat. Can you hear me?
Yes, we can hear you.
Yeah, thank you very much, Abib. It's been insightful. So for the assumptions, the percentages, right? So I want to ask, how do you come up with those percentages? Are they just arbitrary, or you need to check out some company financials, like historicals, to now come up with those percentages? Or what's the basis? Yeah, that's my question. Thank you very much.
Okay, thank you for that question. So I'm on the input sheet now, and from the 2021 numbers, we mentioned that one of the first things to do when you're trying to build your model is to do an historical analysis, which is one of the analysis I was talking about, which is important for you. So all these numbers are not really important. What matters is the analysis. So you need to do an historical analysis to understand the trends over the past periods. So if you look at the yearly sales growth, for example, based on the analysis of this company, for example, it's clear from the input sheet that sales grew by 25% in 2021. So we now know that sales grew by 25%. So when we're building this model for a standard company, what we're going to do is speak to the people running the company and then check the revenue trend growth over the period of time, listen to the strategy they want to implement as a company. And then based on those insights, we can now forecast how the company will grow. So if the management says they are trying to open a new manufacturing plant, they're trying to use more technology to make production process more efficient, and then maybe they just raised more capital from the market, so they have a lot of money and they're trying to grow. And then let's say sales has been growing by 25% in the last few years. You can now say, oh, 20% is too low. Let's increase this to 40% growth based on what we've heard from management. So the numbers is driven majorly by the historical numbers, by the strategic, what the company wants to achieve strategically, what the company has put in place in terms of maybe raising more capital, using more technology to improve operation process, and so on. So that drives how you're building the assumptions to this. And all this, to learn this, to actually put in the right numbers is what makes this model useful, right? And then this is just a very basic explanation of how those numbers come about, right? So I hope that answers it for now. Yeah,
yeah, it does.
Talk more about it.
Brilliant. All right, thank you, Abib.
Okay. Any other questions first? Yes.
All right. Okay.
Okay,
so thank you, Habib, for the presentation. I think we got feedback that a couple of people followed through with the course. So Habib has been sharing, he has run us through like a brief, simple model. And I did mention that Leonine Learning conducts trainings, right? So we launched our financial modeling course in April. Can everyone see my screen? I think everyone can see my screen. So we launched an online course in April this year, and it's called Build Financial Models Like a Pro. So with this course, basically, we all the questions you've asked, how to do the assumptions, how to do the dates, how to do all those other things, the analysis, the dashboards, it comes in here, right? So this course, basically, if you sign up to it, so we're currently doing an 80% off offer. I told you guys we had a ridiculous offer. So normally the course goes for 65K, but we are doing an 80% cost offer, which brings down the price to 13,000. And that's because it's for students. So we do understand that you guys want to get a head start with, what you guys might face in the actual work setting. And we do know that, financial modeling is like a coveted skill. So I know you guys might hear it a lot, but I can tell you for sure that in as much as a lot of people talk about it, right, it's only a few people that really know how to build, standard models. So you can take it from me and from our experience, right, working with people, employers that are trying to get, people on board, like employees on board, right? So only a couple of people know how to build standard models. So based on that, we also know that you will need a lot of time to walk through this at your pace, right? So the course is, we have 7 modules, right? So the benefits for you is that, you get a head start on some of these things, even before you leave school, right? And you can do it at your own pace. You build up your critical thinking, business and financial analysis skill. You get an opportunity to be added to the directory of candidates for potential employers. So we get people that ask us for, employees. They're looking for someone to fill in so and so space. They do reach out to us based on our, their experience with us, right? And you get to work with a group of like-minded individuals. So this would be like a cohort-based program for you. Although it's online, you can do it at your pace, but we have a cycle of 3 months where we expect that at least you've gone through the course, and we'll give you like maximum attention during that time. You also get to be a proficient Excel user because the course has like a full module on like Excel, basically things that you use for modeling, but even that would also help you outside, modeling and helping like everyday Excel use. You get a certificate of completion after you're done attempting the relevant task, and also you get a chance to compete. So we intend to do like a financial modeling competition, but that's if you guys ginger. If you don't ginger, then probably not do it. But if you guys ginger, we intend to do like a financial modeling competition. So we have another course called the How to Build Automated Dashboards, and we did hold like a competition for that one, of which the winner got to enroll in this course, right? But this has exciting prices. I'm not going to mention it, but yeah, depending on your response to this, you will see, okay, are we going to do it or not? But yeah, it's something up for grabs as well. So this is a testimonial from a recent person that took the course, right? So it's an accountant, and he mentioned that he's impressed with the teaching techniques, the clarity of explanation, the visual quality, and the systematic approach to building the models. So he says that he's now in Financial Modeling Pro, right? So like I said, this is the offer we have for you. So we have Financial Model like a pro online course only, which was 65,000, which is 65,000, but we are bringing it down to 13,000 for you guys. And we also have the option where if you want to learn how to build automated dashboards as well, you can have that. So instead of paying 75,000 for that, for the 2 courses, you get to pay 15,000 naira. I'm not going to tell you which one to go for, but I think it's quite clear, right? So if you want to take any of these offers, the offer is open from now to Sunday, the 21st. So I advise that you hop into the offer if you know that you are really serious about learning how to, build models, do the analysis, and all that good stuff. If you join the course now, if you pay for the course, you will get enrolled. You get access to the course on the 24th of August. We'll have an onboarding session with the course instructor. So the course instructor is Hanif Abbas. And so let me show you briefly. So he's Hanif Abbas, and he's the founder of Leonine. He has over 12 years experience in corporate finance, financial analysis, business intelligence, and modeling. So he has built models for over 7 years, starting from his career in Access Bank, right? He's worked with PwC, so you are in good hands, basically. So I'm just going to go through the modules of the course, right? So we have the financial modeling overview, we have the Microsoft Excel, right? We have the financial statement analysis, we have the model building itself, We have scenario and sensitivity analysis. Then you have the dashboard and also how to protect and share your models, because I mean, these are sensitive documents, so you need to know how to protect and share them with external parties, right? So what are the cost requirements? You need a working laptop, Windows preferably, but if you work with a Mac, that's also fine. We do have shortcuts, or we have a way that we show you what you can use instead if you're using a Mac. But you need to understand that some of the capabilities of Excel is not in Mac, right? So we usually advise that if you have a Windows, that would be better. Internet access, of course, installed Microsoft Excel 2016 or above, and also an open mind and willingness to learn. So whether you are in the finance field or it's something that we explain all those things, so all those accounting principles and all that, we explain everything in the course, right? So again, these are some of the things that students are saying, right? So we have Moni Ali that took our course, right? And he said that, you know, he's using those principles that we taught him currently as his role in McKinsey. Then now he's moved on to even founding his own business, right? So that just shows you that these are like skills that you use, you know, throughout. You can use it throughout your working experience or even in your own business, right? Timi Tokwe recently took the online course, and he says that, you know, he's very delighted to be a part of this, and it's a surefire way and headway start for career progression, right? So that's what we have for you. We also have the dashboard, because like I told you, we can, if you want to know more about this, right, I have this open here. And here, basically, you learn the best practice for creating data sets in Excel. You learn how to understand your data. You know, you supercharge your productivity with pivot table, automated reports. You learn how to create charts and other visuals, like Habib said. That's the way that you're able to pass across your message to the user of your model. So it's not just about bringing all the numbers. You need to be able to pass the message across in a succinct manner, right? So that is what dashboards would avail you. And even outside of that, you know, in your regular, if you are in a role that requires a lot of reporting, this will also come in handy for you, right? So just to show you a brief how the platform looks, right? So this is how the platform looks, right? And this is the course, and these are like the content, right? So you have the module 1, which talks about the modeling overview. This is a sample lesson, so you can click it after this. We'll share the links to you. You can go through it and you get like an idea of, you know, what you are getting into. You also have the Microsoft Excel recap. So here, you know, we talk about how to customize your Excel interface, how to design your Excel workbook, you know, entering data, formatting data, you know, the functions, various functions that you use. We also need to state that this course is packed with case studies, right? We have templates, case studies that you have to work on as well. Right, and we're also going to do like a group work where you work in a group to, you know, build a model, analyze it and all that to us, right, before you can be certified, before we give you your certificate of completion, right? You have the financial statement analysis. We break down everything, the income statement, the cash flow statements, other statements that you have, right? Then the model build, we have the model sprints, something similar to this, where you walk through, then we go deep into, we use Dangote as our case study, where we really go through, we do a deep dive on Dangote as a company, right? So we also do the calculations, the ratio analysis. Again, you have case files. Then in module 5, you have assumption updates, you have model driver changes. We have the scenario and sensitivity analysis, where you do your data validation, right? And we have the dashboard, where, you know, you plan your dashboard, you create your dashboard, right? And you have the module where you learn how to protect your model and share, right? So that is about what we have for you in this offer. So again, this offer is open till Sunday, 21st, and it's ready for enrollment. If you want to join, you can grab it now. And this is a price that I don't think I'll ever, when I told Hanif that I wanted to do this price, it's like, but I was like, we need to do this for people, particularly the undergraduates that, need a head start, right, on these skills. And the work environment is becoming increasingly competitive. So, like I said, a lot of people know about financial models, but only a few people know how to build models very well, right? So there are companies that still tell us, they come to us to build our models, and it doesn't mean they don't have finance people in-house, but just they don't have like capable hands to do it, right? So imagine if you could be those kind of people that you don't want to, maybe you want to be the one that they will come and meet you because you left, maybe you left to another company, they'll be chasing after you because they want you to come and build the model and there's nobody else to build the model. Those are real life scenarios I'm painting for you here. So it's not like I'm just saying it, but those are real life situations. So if you have any questions about this offer, you can share with me now, and I'm happy to answer any questions. Just don't ask me technical questions. I'll not be able to answer those ones, but I have people on standby. But if you have any questions on this offer itself, please let me know. Thank you. So is anyone considering the offer? You want to give me? Aisha, you have a question?
Sorry, is it possible I take the how to build automated dashboard course only, or it's a package thing?
Yeah, so you can take it only, but it will not be part of the offer. So only it costs 10,250, right? So you can take that only if you want that only, but it's not part of, like, if you want to take it as a package with the modeling, then that's when it has the 80% off. But you can take it outside if you don't want the package.
Okay.
Any other questions? Aisha, please unmute yourself and speak if you want to ask me a question. Okay, I'm not sure. I'm not sure if you can hear. All right. In the absence of no questions, we'll share the resources. Like we said, we'll share the recording. We'll also share the workings and also the link to, if you want to purchase or enroll in the course, we'll also share it after the webinar. Right. So Habib, you have the floor.
All right. Thanks, Sekinat. Thanks everyone for joining us today. I hope you had a great time understanding the basics of financial modeling. And I will encourage you to take the course so that you can build on the knowledge you've gained today and also master this skill. Thanks again for joining us, and we look forward to having you. And we look forward to having you several more next time.
I look forward to having you on the course, right? So you would see me, if you enroll in the course, I'll be the first person that you see. So I look forward to having you on the course, right? So yeah, so thank you so much for joining us today. All right, thank you so much for joining us. We appreciate you, your time, and we do hope you have an enjoyable weekend. All right, bye everyone.